Let me tell you something straight from the streets of New York City, and from my decades in the business. Real estate is always on people's minds. It's more than just a place to live. It's the biggest investment most people will ever make. That's why, when you hear whispers of a crash or a debt bubble, it's natural to feel a little nervous. As we stand here in the middle of 2025, that's the big question everyone is asking. Are we standing on solid ground, or is the floor about to give way beneath our feet? The headlines are filled with scary words, and it's easy to get swept up in the fear and confusion. The worry isn't coming out of nowhere, that's for sure. We've all seen home prices climb to unbelievable heights over the last few years, making the dream of homeownership feel more like a distant fantasy for many. At the same time, the cost to borrow money, what we call interest rates, has shot up, making those already expensive homes even harder to afford. People are stretching their budgets thinner than ever, and many are taking on significant debt to get a foot in the door. This combination of high prices and high debt is a recipe for anxiety, and it's why so many people are looking at the market with a healthy dose of suspicion. So, what's the real story? Is this just a slight correction after a period of intense growth, or are we on the brink of something much more serious? A real estate crash doesn't just affect buyers and sellers, it sends ripples through the entire economy. It impacts construction jobs, consumer spending, and the overall financial health of the nation. Understanding the difference between a market that is simply cooling off and one that is heading for a full-blown meltdown is crucial. It's the key to making smart decisions, whether you're looking to buy your first home, sell your current one, or simply protect your financial future. In this essay, we are going to break it all down in simple terms. I've seen my share of ups and downs in this business, and I can tell you that knowledge is your best defense against panic. We'll look at what's really happening with prices and sales across the country. We'll explore the strong forces holding the market up and the serious risks that are threatening to pull it down. We will even look back at the great crash of 2008 to see what lessons we can learn. By the end, you'll have a much clearer picture of the situation and know exactly what to watch for. Let's start by painting a picture of what the U.S. real estate market looks like right now, in June 2025. The most important thing to understand is the tug-of-war between prices and affordability. For 22 months straight, the median home price in the United States has gone up compared to the year before. Think about that. Even with all the economic uncertainty, prices keep climbing, hitting an all-time high for April at $414,000. This isn't just a national trend, it's happening in cities big and small. However, this growth is slowing down. It's like a car that has been speeding down the highway and is now easing its foot off the gas pedal. The car is still moving forward, but not nearly as fast as before. The main reason for this slowdown is the high cost of borrowing. Mortgage rates, the interest you pay on a home loan, have been stubbornly high. After a brief dip late last year, the average rate for a 30-year fixed mortgage settled around 6.9% in May. For anyone trying to buy a home, this is a huge deal. A higher interest rate means a much higher monthly payment, even if the price of the house stays the same. This has pushed housing affordability to its lowest point in history. It simply costs more of a family's monthly income to own a home today than ever before, which is sidelining a lot of potential buyers. As you might expect, when things get too expensive, people stop buying. That's exactly what we're seeing. Sales of existing homes have fallen, and market activity is only at about 3/4 of what it was before the pandemic. The spring buying season, which is usually the busiest time of year, has been unusually slow. It's not that people don't want to buy houses, the demand is still there. It's that they can't make the numbers work. They are getting priced out of the market by the double punch of high home values and high borrowing costs, creating a standoff between buyers and sellers. This trend isn't the same everywhere, of course. Real estate is always local. In cities like Austin, Texas, and parts of Florida, we're seeing more homes come up for sale. This increase in inventory is giving buyers more choices and a little more power to negotiate. In contrast, places in the Northeast and Midwest like Buffalo and Rochester still have a severe shortage of homes for sale. This means buyers there are still facing bidding wars and fierce competition. Understanding your local market is more important than ever because the national headlines don't always tell the whole story for your specific neighborhood. Now, with all this talk of high prices and slow sales, you might be thinking a crash is inevitable. But hold on. There are some very powerful forces at play that are acting like strong pillars, holding the market up and preventing a total collapse. The single most important factor is the simple rule of supply and demand. Right now, there are far more people who want to buy a home than there are homes available for sale. For years, the U.S. has not built enough new houses to keep up with population growth. This shortage is estimated to be somewhere between 2.3 and 6.5 million homes. This lack of inventory is the market's strongest safety net. Even if some buyers are forced to drop out because of high rates, there is a long line of other potential buyers waiting to take their place, especially if prices or rates dip even slightly. This is completely different from the situation before the 2008 crash, when we had a huge surplus of homes. Today, the supply of homes for sale is about 4.4 months. That means if no new homes were listed, it would take just over 4 months to sell everything on the market. A balanced, healthy market usually has about 5 to 6 months of supply, so we are still very much in a seller's market, which keeps prices from falling off a cliff. Another huge difference between today and the past is the financial health of current homeowners. Before 2008, lending standards were dangerously loose. People were getting mortgages they couldn't truly afford. Today, the rules are much stricter. Buyers have to prove they have good credit and a stable income. Because of this, homeowners today are in a much stronger position. In fact, homeowner equity, the difference between what a home is worth and what is owed on the mortgage, is at a near-record high of $34.7 trillion. Almost half of all homeowners with a mortgage are considered equity-rich, meaning their loan is 50% or less of their home's value. This massive cushion of equity is critical. It means that even if someone loses their job or faces a financial emergency, they have options. They can sell their home and likely walk away with a significant profit, rather than facing foreclosure. This prevents a flood of distressed properties from hitting the market and driving down prices for everyone else. Furthermore, a strong job market continues to support the housing market. As long as people are employed and earning steady paychecks, they can continue to make their mortgage payments. A widespread crash would likely require a sharp rise in unemployment, which most economists are not predicting for 2025. Even with those strong pillars of support, we can't ignore the cracks that are starting to appear in the foundation. The biggest and most obvious risk is the affordability crisis. When homes become so expensive that the average family cannot afford to buy one, the market becomes fragile. This isn't just a problem for first-time homebuyers. It also creates what we call the lock-in effect. Millions of current homeowners are sitting on mortgages with ultra-low interest rates of 3 or 4%. They are reluctant to sell their homes and move because buying a new one would mean taking on a new mortgage at a rate closer to 7%, dramatically increasing their monthly payments. This lock-in effect freezes the market. It keeps the supply of existing homes for sale artificially low, which perversely keeps prices high, making the affordability problem even worse. It's a vicious cycle. While this effect is starting to ease a little, the number of homeowners with rates below 5% has dropped from 86% to 73%. It remains a major hurdle. The market needs a healthy flow of homes being bought and sold, and right now, that flow is more like a trickle. This stagnation is a risk because it makes the market less dynamic and more vulnerable to sudden shocks. Another growing concern is the rise in consumer debt and delinquencies. While lending standards for mortgages are tight, Americans have been taking on more credit card debt and car loans to cope with inflation. If the economy were to slow down and job losses were to increase, some families would have to make tough choices about which bills to pay. We are already seeing a small but noticeable increase in mortgage delinquencies, which are payments that are more than 30 days late. Foreclosure starts in April 2025 were up 16.1% compared to last year. While these numbers are still far below the crisis levels of 2010, the upward trend is a warning sign that we need to watch closely. Finally, we have the wild card of inflation and Federal Reserve policy. The Fed has been keeping interest rates high to fight inflation, which is currently at 2.3%, still above the 2% target. The entire real estate market is hanging on the Fed's next move. If they keep rates high for too long, it could choke off the market completely and potentially tip the economy into a recession. A recession would lead to job losses, which is the one thing that could truly trigger a housing downturn. The uncertainty around future policy makes it very difficult for both buyers and builders to plan, adding another layer of risk to an already complicated picture. Whenever the housing market gets shaky, everyone's mind immediately jumps to one thing: the 2008 financial crisis. It was the most devastating housing crash in modern history, and the memory of it still looms large. So, it's a fair question to ask. Are we seeing a repeat of 2008? In short, the answer from nearly every expert is a firm no. The market today is fundamentally different from the one that collapsed back then. Understanding these differences is key to putting our current situation into the proper context and easing some of the biggest fears people have. The single biggest difference lies in the lending practices. The 2008 crisis was fueled by reckless and fraudulent lending. Banks were handing out subprime mortgages to borrowers with no income, no job, and no assets, what we called ninja loans. These loans often had teaser rates that would later explode into payments the borrowers could never afford. When those people started defaulting, the whole house of cards came tumbling down. Today we are in a completely different world. Thanks to new regulations, getting a mortgage requires thorough documentation of income, a good credit score, and a sizable down payment. The borrowers of today are much more qualified and resilient. Another critical distinction is the supply of housing. In the years leading up to 2008, builders were in a frenzy, putting up new homes and condominiums everywhere. This led to a massive oversupply of properties on the market. When the crash happened, this glut of empty homes caused prices to plummet dramatically as desperate sellers slashed prices to get out. As we've already discussed, today's situation is the complete opposite. We have a severe and chronic shortage of homes. This fundamental lack of supply acts as a floor under home prices, making a 2008-style price collapse highly unlikely. There are simply too many buyers competing for too few homes. Finally, let's look at homeowner equity again. In 2008, many people had very little or even negative equity in their homes, meaning they owed more on their mortgage than the house was worth. This gave them no choice but to walk away and let the bank foreclose when they ran into financial trouble. Today, as we know, homeowners are sitting on trillions of dollars in equity. This financial cushion not only prevents foreclosures but also gives the market incredible stability. It means homeowners can weather financial storms without having to resort to a desperate fire sale of their property, which is what ultimately sinks a market. So, if you are looking to buy a home or invest in real estate in this complicated market, what should you do? My best advice has always been the same, regardless of the market conditions. Don't rush. Panic is your worst enemy. Buying a home is a long-term decision, not a short-term gamble. The fear of missing out, or FOMO, can lead you to overpay for a property or stretch your budget beyond what is comfortable. Take a deep breath and remember that you are in control of your own timeline. The right house will be there when you are truly ready, financially and emotionally. The first practical step is to get your financial house in order. This is non-negotiable. Before you even start looking at listings online, you need to know exactly what you can afford. Talk to a lender and get pre-approved for a mortgage. This will give you a realistic budget to work with and show sellers that you are a serious buyer. Look at your monthly income, your existing debts, and create a detailed budget that includes not just the mortgage payment but also property taxes, insurance, maintenance, and utilities. Being financially prepared is the best way to stay safe and confident in any market. Next, you need to become an expert on your local market. As we've seen, real estate conditions can vary dramatically from one city to the next, and even from one neighborhood to another. Do your homework. Track how long homes are staying on the market in your target area. See what percentage of the asking price they are selling for. Are sellers offering concessions? Are builders offering incentives on new construction? In some areas, builder price cuts and sales incentives are becoming more common, which can present a great opportunity for savvy buyers who are willing to consider a new build. Finally, be flexible and patient. In this market, you might not find your perfect dream home right away. You may need to compromise on the size, location, or condition of the property. Perhaps you need to look in a neighboring town you hadn't considered, or be open to a house that needs a little bit of cosmetic work. The key is to focus on buying a home that fits your budget and meets your most important needs. Don't get discouraged if your first few offers aren't accepted. The market is slowly shifting, and patience will eventually pay off for disciplined and well-prepared buyers. So, after looking at all the evidence, is the U.S. real estate market heading for a crash in 2025? The overwhelming consensus among experts is no. A crash on the scale of 2008 is not on the horizon. The market is being held up by strong fundamentals, including a severe housing shortage, high homeowner equity, and strict lending standards. These factors create a powerful safety net that should prevent a dramatic widespread collapse in prices. The market is not built on a foundation of sand like it was in the mid-2000s. Today's foundation is much more solid, built with better materials. However, that does not mean everything is perfect. We are not in for a smooth ride. The market is clearly in a period of correction and transition. The affordability crisis is very real and is causing significant pain for potential buyers. High interest rates are acting as a brake on the entire system, slowing sales and locking many current homeowners in place. We must keep a close watch on the warning signs, rising delinquencies, the direction of inflation and Fed policy, and the health of the job market. A significant economic downturn that leads to widespread job losses remains the biggest potential trigger for a more serious housing correction. For anyone involved in real estate, whether you're a buyer, a seller, an investor, or just a homeowner, the key takeaway is the importance of staying informed. Don't let fear or hype guide your decisions. Instead, focus on the data. Understand the difference between national headlines and your local reality. The dynamics in Austin are not the same as in Buffalo. Know your own financial situation inside and out, and make decisions based on what is best for you and your family over the long term, not on what you think the market might do in the next 6 months. Ultimately, the story of the 2025 real estate market is one of tension. It's a tug-of-war between the powerful forces of low supply and high demand on one side, and the heavy weight of poor affordability and high interest rates on the other. For now, the rope is holding steady in the middle, resulting in a slow, gridlocked market rather than a freefall. Watching how these competing forces evolve over the coming months will be essential for understanding where we are headed. This isn't just a story about numbers and graphs, it's about the financial security and dreams of millions of Americans.